Good evening. Welcome to Kenya News Update today. I'm your host, and we're diving deep into a story that's rippling through global markets and boardrooms. Microsoft, the tech behemoth, just experienced its worst single-day stock drop since 2020, a staggering 10% plunge that vaporized hundreds of billions in market value in mere hours. But today, the stock is flat, motionless. The bleeding has stopped, but the questions are just beginning. Why did it fall so hard, and what does this tell us about the future of tech, the cloud, and the global economy? We'll unpack it all with expert analysis and a look at the broader context, including a major geopolitical move by the European Union. This is our deep dive. Let's start with the numbers because they are breathtaking. On Thursday, Microsoft shares fell by a full 10%. That single-day decline wiped out a colossal $357 billion from the company's market capitalization. To put that in perspective, that's more than the entire annual economic output of many nations. It's a loss of value so vast it's almost abstract. But the market's reaction today is equally telling. The stock is essentially flat. It's not rebounding with vigor, nor is it continuing its freefall. It's in a state of suspended animation, as investors and analysts worldwide hold their breath and reassess. The immediate trigger, according to the company's latest earnings report, was a slight deceleration in the growth of its crown jewel, the cloud computing segment, specifically Azure. While still growing at an impressive clip, it grew slightly slower than the hyper-optimistic expectations baked into the stock's premium valuation. In the high-stakes world of trillion-dollar companies, missing expectations by even a fraction can trigger an avalanche. But is that the whole story? Let's bring in our first perspective. Many analysts on Wall Street are framing this as a classic growth scare. Microsoft has been a market darling, a pillar of the magnificent 7 tech stocks that have driven indices to record highs. Its valuation assumed near-perfect, uninterrupted growth, particularly in AI and cloud services. When Azure's growth came in at, say, 28% instead of an expected 29%, the high wire act wobbled. Jim Tierney of AllianceBernstein, however, argues investors are missing the bigger picture. He suggests that focusing on a single quarter's minor growth fluctuation ignores Microsoft's immense competitive moat, its integration across enterprise software, and its long-term AI roadmap. From this viewpoint, Thursday's sell-off was an overreaction, a necessary correction that shook out weak hands but doesn't fundamentally impair the company's trajectory. The flat trading today in this narrative is the calm after the storm, with smart money starting to see a buying opportunity in a temporarily discounted blue chip. Now, let's contrast that with a more critical take. Our second perspective comes from skeptics who believe this drop is a symptom of a larger bubble in tech valuations. They point out that Microsoft's price-to-earnings ratio had soared to levels that demanded flawless execution. The cloud market, while still expanding, is facing increased competition from Amazon's Oz and Google Cloud, potentially squeezing margins. Furthermore, the enormous capital expenditures required for AI infrastructure, building those massive data centers, may weigh on profitability for years to come. This camp sees the 10% drop not as an overreaction, but as a logical and perhaps overdue reckoning. The flatlining today isn't stability, it's indecision. It's the market pausing before potentially deciding that even this new, lower price isn't justified if growth continues to normalize from its pandemic-era peaks. They warn that if next quarter's guidance also disappoints, this flat line could be the precursor to another leg down. To understand the stakes, we need to visualize the scale of this business. Microsoft's intelligent cloud segment, which houses Azure, is a financial behemoth in its own right. In the last quarter, it generated revenue of approximately $26.7 billion. More importantly, its operating income was a staggering $12.6 billion. That's pure profit from one division in 3 months. The Productivity and Business Processes unit, which includes Office and LinkedIn, brought in around $19.6 billion. And more personal computing, with Windows and Xbox, contributed about $15.8 billion. The company is an empire, but the cloud is its engine room, and all eyes are on its growth rate. If we look at Azure's year-over-year revenue growth, it has been a remarkable story. From growth rates soaring above 50% a few years ago, it has gradually and naturally moderated. The market was expecting it to stabilize at a very high level. The fear is that this latest figure might signal the start of a steeper than anticipated decline in that growth curve, which would mathematically justify a significant derating of the stock. This brings us to the global context. A company like Microsoft doesn't operate in a vacuum. Its fortunes are tied to the global economic climate, corporate IT spending, and geopolitical stability. And on that last point, we saw a significant development this week that reminds us how interconnected our world is. The European Union formally added Iran's Islamic Revolutionary Guard Corps, the IRGC, to its terrorist list. This is a major diplomatic and sanctions escalation by the 27-nation bloc. While not directly linked to Microsoft's earnings, it's a stark example of the kind of geopolitical friction that can unsettle global markets, affect energy prices, and create uncertainty for multinational corporations. In a world where tech companies rely on complex global supply chains and serve customers worldwide, such events contribute to a background level of risk that investors must price in. A flat trading day for Microsoft might reflect not just internal company analysis, but also investors digesting a multitude of global headlines. Let's delve deeper into the financial mechanics. The $357 billion loss in market cap is an almost unfathomable number. But what does it mean in terms of ownership? A huge portion of Microsoft is owned by institutional investors, pension funds, mutual funds, and ETFs. A 10% hit to Microsoft translates to billions in losses for these entities, which in turn affects the retirement savings and investment portfolios of millions of ordinary people. This is why such market moves matter far beyond Wall Street trading desks. Furthermore, Microsoft is a heavyweight in major indices like the S&P 500 and the Nasdaq. Its sharp decline acted as an anchor, pulling down the entire market on Thursday. Today's flat performance prevents further immediate drag, but it also means it's not providing the lift that index funds often rely on from their largest components. The stock's inertia creates a vacuum of leadership in the market. Now, let's consider the competitive landscape. Microsoft's Azure is in a fierce battle for market share. Industry estimates often show Amazon Web Services holding the lead with roughly a third of the market, Microsoft Azure in second place with about 23%, and Google Cloud trailing in third. Every percentage point of growth is fought for intensely. The concern from Thursday's report is that Azure's growth deceleration might mean it's losing ground, or that the overall market growth is slowing. However, Microsoft has a unique advantage: its vast suite of enterprise software, like Office 365 and Teams, which it can use to bundle and cross-sell Azure services. This commercial cloud package is a powerhouse. Its gross margin has been expanding and stood at an impressive 72%. The question for investors is whether this high-margin, sticky business can offset any cooling in the raw infrastructure growth of Azure. There's also the AI wildcard. Microsoft has bet big on artificial intelligence through its multi-billion-dollar partnership with OpenAI, the creator of ChatGPT. It's integrating AI copilots across its entire product line. This investment is colossal and is part of those heavy capital expenditures we mentioned. The promise is that AI will unlock new revenue streams and efficiencies, but the payoff is years away. In the meantime, it costs money. Some analysts worry that the AI gold rush is leading to a cycle of excessive spending with uncertain returns. If cloud growth is moderating just as AI spending ramps up, it could pressure profitability. This complex calculus is what has investors paralyzed, leading to this flat trading pattern. They are trying to weigh the immense potential of AI against the present-day reality of cloud growth metrics. So, where do we go from here? The flat stock price today represents a stalemate between the bulls and the bears. The bulls see a world-class company with a temporary hiccup, now trading at a more reasonable valuation. They point to Microsoft's fortress balance sheet, its consistent dividend, and its diversified revenue streams. The bears see a peak in the cloud growth cycle and an AI bubble. They argue that a 10% drop might not be enough, and that the stock could trade sideways or lower for an extended period as the story resets. For the broader market, Microsoft's fate is a bellwether. If it can resume its upward trajectory, it will calm nerves about the tech sector's durability. If it breaks down from this flatline, it could signal a deeper rotation out of growth stocks. In conclusion, Microsoft's 10% plunge and subsequent flatline is more than a stock story. It's a case study in modern market psychology, where trillion-dollar valuations hang on decimal points of growth rates. It's a reminder of the immense concentration of wealth and influence in a handful of tech giants. And it's playing out against a backdrop of geopolitical shifts, like the EU's move against Iran's IRGC, that remind us of the fragile ecosystem in which global business operates. For investors in Kenya and around the world, the lesson is about diversification and the perils of chasing momentum. Even the mightiest companies are not immune to the market's sudden reassessments. The coming weeks will be crucial. Will Microsoft's flatline be the launching pad for recovery, or the quiet before another storm? Only time and the next earnings report will tell. This has been our deep dive. For continued coverage of this and all stories affecting Kenya and the global markets, subscribe to Kenya News Update today.